right, good afternoon, good morning, good evening, wherever you are. We are introducing a three-part series on retirement savings plans that we'd like to share with our community. So we are going to get into the different layers, somewhat of the benefits of these retirement savings plans, specifically for our folks out there who have their own businesses or are part shareholders or partners vested in an organization that's actually out there doing something, right? We want to make sure that everybody understands and has the information to make the best decisions concerning how to shift money, possibly away from just giving it up in taxes, to maybe a future benefit, i.e. retirement plans, programs for your company, for yourself as a shareholder, for yourself as a partner. So that's why we're doing this, and that's what we're going to go into. This particular session is focused on SEP, Simple IRA plans. My experience and my understanding as an accountant and as a tax preparer is limited. What I do understand from a tax point of view is that it allows us to take some deductions at the end of the year when it comes to how much we invested in it. Depending on our age, it might be bumped up a little bit, but that's the benefit from a tax perspective. From a financial planning perspective, that's why we have our professional Robert here. He's going to introduce us and give us some insight into how we can understand that through the actual beneficiaries' point of view. Robert, I'll give it over to you.
Oh, all right. Thanks, Aaron. So when we talk about retirement savings plan, like Aaron mentioned, Simple IRA or SEP IRA, not necessarily the most interesting topic, but what I find out is it's important to know why they are utilized the vehicle. So in the longer term, in the future, you can try to defer as much taxes as you can, and at the same time, invest in the platform, right? So when we talk about IRA, there's the most common one is the traditional individual IRA or Roth IRA, and so basically what those are qualified plans, and then the only difference is when they get taxed by the Uncle Sam. Either it's in the beginning, right, and while the investment is in the funds itself, it grows tax deferred, and then when you take it out, then you don't have to pay taxes, and after 59.5, and those are called the Roth IRA or Roth provision.
I think we can stay there for just a little bit, because the reason why I say is because we have clientele that are at the beginning stages and at the ending stages, and depending on where you are, you're going to feel the hammer. I shouldn't say it like that. That's being dramatic. But you're going to feel some kind of way or something from Uncle Sam, right, be it the beginning or the ending. So I think that's a good point to maybe spend a few moments on it, and let's talk about, okay, so the Roth is the one that is tax deferred.
It's the money is already taxed.
Okay, so it's
already taxed. Yeah.
Okay, so it's already taxed when it comes in. So every year, if my IRA grows, dividends, interest, earnings, do I report that tax? Or report that income every year, so that when I get it out at the end, it is just not taxed at all. Is that how it works, or?
Yeah. So that's the great thing is it's always great tax deferred, right? As long as you keep it in there, and then for at least depends if you're withdrawing from, go into more detail, from the gain portion of it or the principal that you put in there, because then it comes to, there's a 5-year Roth rule. Okay. But the general rule of thumb is as long as you keep in there and then you withdraw after age 59.5. Okay. Then that funds you have in the Roth IRA won't be taxed anymore.
Really?
So
okay.
One simple way to put it, I tell, is you're only gonna get taxed once. when you're in a qualified account. Either it's in the beginning or at the end when you take out the money.
Interesting. So the Roth every year we put in, so the corpus is there, right? And the gains though on the corpus, if we let it sit and do its thing and then we're patient and we wait until it's time for us, 59.5, whatever it might be, and then we take it out, we're good to go. As long as we do those steps the correct way, right?
Right, yep.
Okay,
yes.
okay, all right, okay. Now let's flip the script. Now how about the other IRA? So that's the no tax now in the duration, but at the end, when it comes out.
Right.
Okay. And whatever rate we are in 2030 or 2040, whenever it is, that's the rate we have to bear that burden of where we, coming out at.
Correct. Yeah.
Okay.
Of course, based on the income tax and tax bracket, which that's something you could help the client with.
Yeah. Okay.
So.
Okay.
So for the traditional IRA or SEP or Simple IRA, a majority of them are on the pre-tax basis.
Okay.
Right, which means is the money that you put in are not taxed. In some ways, pre-taxed. And then while the fund is growing, grow tax deferred. Then when you withdraw, and that's there's some
Okay.
Okay.
Okay. So that's and so. I think we should just take a commercial break. Not a commercial break from you, but just commercial break from our discussion, just to really understand that, because we have some of our people out there that are receiving benefits right now. Some of our people out there are contributing benefits right now, and those of you who are receiving the benefits, you might be on that end, and questions might come up, because I know I had one client. This is her first year in retirement, and she was wondering, hey, she didn't quite understand, but the program that she was in, it was the SEP, and so her funds coming out were taxed, and they were taxed at whatever bracket she was in based on all of the other income that she brings, not just from the retirement program, but any other income that she's bringing in in a given year, will put her in a certain bracket, and she could, she's going to have to pay taxes on whatever she earns in that bracket. So just to make sure that you all understand it, and so for the folks that are putting money in, be cognizant and aware that there are different types of IRA programs, and you might think you're in one, but need to be in another, or want to be in another. So make sure that you review that if you do have a plan like that, and make sure that you're in the appropriate one. Now, speaking of that, Robert, if we do have people out there that say, hey, you know what, I've been given to, I was told this a long time ago to put it in this type of program, but I really want to be in the Roth, or I really want to be in the SEP. Like, what can they do? Like if they're in the middle of life, or middle of their working career?
That's a great question, Aaron. And the answer might be very general, but at the end of the day, it really depends on the client's situation and how they want to accomplish. For majority of the individuals or business owners is for long-term goal, right? Then in this case, it's a lot of in some way personal belief too, right? Whereas you say, do you think is the tax gonna go up in the future, or is the tax gonna go down? And the truth is, we don't really have that crystal ball to know where it can be. So if the investors want to make sure that they cover all the grounds, a lot of time what we can suggest them to do is to either convert to a Roth conversion, so convert part of the traditional IRA, or that that wrap to convert to a already taxed Roth vehicle. But now, is to be aware of is, of course, which year that is converted, it has to claim as an income for that specific year.
Okay.
And in these cases, we talk about don't put all the eggs in one basket, and with diversification in a way, so we can cover in case of tax rates going up or going down, then at least we're both in the, both vehicles are in the game to kind of hedge each other in some way. I don't know if that kind of, yeah.
That makes sense. Okay. So that kind of leads us, and I'm gonna kind of move us into like talking on the plans themselves. I know we mentioned a few things about it. So let's do maybe like a one-on-one. So the Simple Employee Pension. So that's the SEP. What I have here is what is it, who contributes, main benefits, tax implications. So I'll deal with the tax implications, but for the layman and laywoman, like what is it? We hear it all the time, SEP. You know what I mean? You think of self-employment when you say that.
Right.
But what actually is that vehicle? What is that?
It is a very low-cost way to create a retirement plan that allows the employer or the employee, tends to be like small business, family business, to contribute a lot more than a traditional IRA that a person can contribute. And the beauty of it is very low cost, low administration, which means there's not too many specific form they have to file. But the other big benefit is it's definitely very flexible. So who contribute the SEP IRA are the employers. That's the thing. So the employees do not have the privilege to invest into their SEP IRA.
I see.
So that's that's one of the disadvantage, I think, in some way, which other plans do have that.
Now let me ask you this, because that's interesting. Now not most, all of our clients who have a SEP, they actually, as owners, as shareholders, they contribute. But is there a option for the employer to say, okay, I know you can't contribute, Tom, I know you can't contribute, Sina, I know you can't contribute, Sally, but I'm gonna contribute for you. Could they do something like that? Or they wouldn't even qualify for that?
They, in terms of SEP, it is something that think about it, it's a retirement plan. At the end of the day, what the government wants a business owner to do is to help employee to contribute for their retirement plan. So in some way, as a business owner, they do not want them to in some way discriminate against someone else. So in this case for SEP, if you decide to contribute, you have to let other employees. And if I recall correctly, the minimum employee, I think as long as they make like $500 a year or something very minimal, then the employer has to help them to contribute as well. Yeah.
But it has to be like a standard where we're not picking Amanda out and saying, hey, we're gonna give you some extra on the side,
right?
And then Tom, we don't kind of like you, you know what I mean? So I got it. Okay, so but that's interesting because I did not know that. Yeah. Okay.
And just to throw a little bit in there too is employee they can contribute up to 25% their qualified income for that specific year. That's the max. Or 61,000. I believe that's for 2022. And for employer, they can put 20% of their qualified income for that specific year, or 61,000, whichever is less. Yeah.
Okay, from a tax perspective, so we know so the employer can do that. So as a owner, and I'm doing it, I'm putting in my portion. I know when I go to T-SOA and I'm saying, okay, I need you to do our taxes, right? And so they come to us and then we do them and we say, okay, how much did you contribute? And they say, okay, we contribute this. Okay, your max is this, so we can take a deduction for this. But on the other hand, if the employer were to contribute their share, how would and I guess this gets into the weeds of it, because I know as a tax professional that the owners, the benefits, that's a no-no. But if it's benefits for employees uniformly, like we just discussed, then we can take that as a deduction. Is SEP something that, not for the owners, I know the owners, for the employer's tax return, the owners, we're not able to deal with their benefits as far as what they contribute in. But if the employer says, hey, we got 5 or 6 or 7, however many employees that we have been putting in for them, is that something that's on the table? Because, and here's what I'm asking, because the employees might not be giving anything, right? Or they're not giving anything. It's the employer giving all.
Correct.
But it's for the benefit of the individual, the employees.
Correct. Yeah.
Would, and here's where like this brainiac side of me coming out.
Yeah.
So if that's the case, is there some, and this might be in the later session, but is there some type of vesting that has to occur before that those retirement plan programs, whatever we want to call them, are actually the benefit, even though it's future, it's the benefit of the employee? Is there some type of time or some type of amount that has to be hit in order to say, okay, I'm the employee, my company's been giving such and such to me, and I can start bragging about it. Yeah, I got this retirement kind of a thing. Does that ever happen, or is it anything like that?
Those are great question there. And for the SEP IRA, in terms of vesting schedule, the contribution that employer makes for the employee or themselves as employer are 100% vested already. So there's no certain period. And I think of course that's set for a certain other type of retirement vehicle. There might be way to that can have that vesting period for the employee. So in that case, then it's the employer wants to be that that Tesla of company, that number one, where they can hold their employees right and make sure they're happy. So having retirement plan give that advantage, comparative advantage comparing to the competitors who do not have a retirement plan. And as a business owner too, I think that's something very very beneficial.
That, and you speaking, I guess another commercial break, not commercial for us, but it's actually, it shows like those of you out there who are business owners and you own your S corp, your partnership, or your LLC. It's just creating value for your work, for your employees, your staff. They feel valued if you are willing to go the extra mile. Like, hey, we want to make sure that you guys are not only taken care of right now, but you're taking care of in the future. Because that's what you're saying actually when you set things like this up. Okay, so though I do have a big question, but I'm gonna wait because I want to get into the Simple IRA.
Okay.
What that is, who contributes, and the main benefits of that.
So let's talk about Simple IRA. So for the Simple IRA, the big difference between, let's go that way. The difference between SEP and Simple IRAs are the employee actually can contribute their Simple IRA plan. And it tends to be for employer or business owner who have 100 employees less. That's something they can set up for a Simple IRA. And the reason why it's called Simple is because it's very simple, it's very easy to set up. Not too much paperwork, not too much form to set it up. But there's a caveat for the Simple IRA. Is there some rules and regulation and restrictions that they have to follow for that.
So now this gets into the bigger question, and it brings in the Simple and the SEP. Who actually manages that? Like because it's simple to set up, it's simple to get in. Like, who actually do we go to so the folks out there that says, you know, I would just want to have one of those plans. You know what I mean? Like, where do I go to? Like, who actually manages that, and who do we as, you know, employers, and where do we need to go to actually link up with an organization, program, or person that helps us to manage that?
So definitely, if they can look for a financial advisor. If they already have one, they can always consult a financial advisor to start a plan, or they can reach out to us. Right? That's something that we can definitely evaluate the situation and come up with a plan that's most suitable for the participants or plan sponsor, to be more correct. Correctly terms, plan sponsor, to achieve that.
So the reason I say that is because Robert is being modest, you know what I mean? So it's, I'm just letting you know, like, you it's not that easy, right? It's you have to like figure out, like, where do I go to get this, you know? Because it is an asset, you know. It is an asset, and it's accruing benefits over time for your future, you know, or your employee's future. So it's something that, you know, has to be sought out and has to be managed by an expert, you know, even though it's simple to set up. But again, Robert's being really modest about that. To me, it's not really simple to set up.
Right.
You gotta identify the person that can help you, you know, walk you through like what forms to sign and things of that nature. But having a value person on your team to help you manage that and navigate, because we just talked about the differences. We talked about the benefits from one versus the other, preference. You know, you need somebody that you can link up with professionally that has the expertise that can navigate you through. Okay, what is it that you want? What's your expectation for now, for short term, long term, and they can help you navigate your way to, you know, where you need to be as far as what's in your mind for yourself and for your organization and ultimately your employees. So, yeah.